If the money in your savings account earns 1% a year, your money takes about 72 years to double. That's basically a lifetime. But don't worry, there's a simple 5-second check that shows if your money is really growing, the rule of 72. Take 72 and divide it by your annual return. That's how long it takes to double your money. 1%, 72 years. 4%, 18 years. 8%, 9 years. 10%, 7.2 years. But here's the catch: inflation. If prices rise faster than your return, that double buys less later. In this video, I'll walk you step by step to use the rule of 72 to set clear, simple goals, convert to real returns so you know what you can actually spend, pick better growth engines for your money, run a quick 10-minute checkup on every account. Stick with me for the secret step, turning nominal doubles into real purchasing power, so you leave knowing exactly how to double your money the right way. Let's make this simple. If your savings earn 1%, but prices go up 4%, you're really losing about 3% a year. Your bank balance shows more dollars, but those dollars buy less. It's like walking up a down escalator. You're moving, but you're still going backward. Here's the thing most people miss. We look at the nominal number, the raw balance, and feel good because it's bigger than last year. But your grocery bill, rent, and utilities don't care about your nominal balance. They care about purchasing power. If purchasing power shrinks 3% a year, that loss compounds against you. 10 years of a small drag can erase a big chunk of what your money can actually do. Think about the math. At 1%, the rule of 72 says your money doubles in 72 years. Sounds safe. But if inflation averages 3% over that stretch, your double may buy the same or even less than what you started with. That's the trap. Safety for principal isn't safety for wealth. Your cash is intact, but the value is leaking. Now, the reason this hurts is compounding erosion. Compounding works both ways. When returns are above inflation, compounding accelerates your progress. When inflation outruns your return, it compounds the damage. Each year, your starting base has slightly less buying power, so next year's loss hits a smaller base, and the gap widens over time. Let me show you a quick conservative lens you can keep in your head. Real return is roughly nominal return minus inflation minus fees minus taxes. It's not perfect, but it keeps you honest. If you're earning 3%, inflation is 4%, fees and taxes eat another 1%, you're around -2% real. That stretches your doubling time to never, because you can't double purchasing power with a negative real rate. And here's where Rule of 72 becomes your dashboard. It's useful for two views. First, the nominal check, 72 divided by your return. At 5%, you double in about 14.4 years. Second, the real check, 72 divided by your real return. If your real return is 2%, your purchasing power doubles in about 36 years. At 4% real, about 18 years. That's the difference between feeling stuck and making visible progress in a working career. There's another leak most people forget: friction. Fees lengthen your doubling time. Taxes do too. A low 1% annual fee doesn't look scary, but it's 1% every year, forever, compounding against you. The mistake is thinking of it as a one-time haircut. It's a treadmill tilt. Consequences? Retirement shock. You log in, see a big nominal number, but withdrawals don't go as far as you expected. The budget feels tight. You start making trade-offs you didn't plan for. The fix isn't to swear off safety. It's to understand that safe has to mean wealth safe, not just principal safe. If you remember nothing else from this section, remember this. You need a return that beats inflation after fees and taxes. That's wealth safety. And once you see the leak, you'll want a fast way to judge speed. That's where the rule of 72 comes in. Your simple, on-the-spot dashboard for whether your money is actually pulling ahead. Now that you see the leak, here's the shortcut you can run in your head anytime. The rule of 72 says, take 72, divide by your annual return, and you get the rough years to double. It's most accurate for steady annual returns in the 4% to 15% range, but it's still a powerful quick check outside that range. The value isn't perfection, it's speed. You'll know in seconds whether something's moving fast enough to matter. Let's get a few mental reps so it sticks. At 3%, 72 divided by 3 is 24 years. At 6%, it's 12 years. At 8%, it's 9 years. At 10%, it's 7.2. Those jumps are huge. Doubling in 12 versus 24 years is the difference between getting 2 doubles in a career or barely getting 1. And remember, each double stacks on the last, so later doubles are worth far more dollars.
Here's how to use this for real decisions. If you've got a 25-year horizon to retirement, ask, how many doubles can I reasonably fit? At 6%, you might squeeze in about 2 doubles. At 8%, you're closer to almost 3. At 10%, you're a bit over 3. That mental model instantly tells you if your current mix has a fighting chance or if you're crawling toward a target that keeps moving. Practical workflow. Do this on one sheet of paper. List each account: savings, brokerage, Roth, 401k. Next to each, write the current yield or your long-term assumed return. Now divide 72 by that number. You'll get an implied nominal doubling time per account. If your savings account says 72 years and your index fund says 7 to 10 years, the prioritization becomes obvious. This is your dashboard: fast, visual, and honest. Common mistakes to avoid. First, ignoring frictions. Fees and taxes slow the compounding engine, lengthening your doubling time. A 7% fund with 1% in fees isn't 7% to you. It's more like 6% before taxes. Second, mixing averages with expectations. An asset that averaged 10% historically won't deliver 10% every year. Don't expect calendar-perfect doubles. You're estimating the long arc. Third, over-trusting accuracy outside the sweet spot. At 1% or 30%, the rule is cruder. Use it as a ballpark, not a promise. Here's the shortcut nobody teaches. Use 72 twice. First pass for nominal, second pass for real. Nominal tells you the speedometer your statement shows. Real tells you the speedometer your grocery cart feels. If you remember nothing else here, remember that double pass. It keeps you from celebrating a win that inflation quietly erased. Once you nail that, everything else clicks. You'll find yourself doing micro decisions better. Should I keep paying down a 6% loan or invest in something likely to earn 5%? 72 over 6 is 12 years. 72 over 5 is about 14.4. The loan's compounding against you faster than your investment compounds for you. That single comparison can save you thousands. Now this next part separates beginners from pros. Doubling speed is only half the game. Time invested is the multiplier. You can't buy lost cycles later. Therefore, in the next section, I'll show you why starting earlier beats throwing more money at it later, and how to set up your contributions so the doubles keep rolling without you overthinking it. Now, let's talk about the multiplier most people underestimate: time. You can raise your contribution later, but you can't buy back lost years. This is the game changer nobody talks about enough, and once it clicks, you'll never look at, "I'll start next year." the same way again. Here's the simple setup. Two people, same return, different start dates. Alex starts earlier with smaller contributions. Jordan waits a decade, then invests more each month. Most people assume Jordan wins because, well, more money going in should win. But here's the thing. Compounding doesn't care how impressive your monthly number looks if it doesn't have time to work. Let me lay out the numbers so you can feel it. Use a 10% annual return to keep the math consistent with our Rule of 72 benchmark, about 7.2 years per double. Alex starts at 25, invests $300 a month, and keeps going for 30 years. Jordan starts at 35, invests $500 a month, and keeps going for 20 years. Same return, different timelines. The difference is the missing doubles. At roughly 7.2 years per double, Alex's money sees just over 4 doubling windows across those 30 years. Jordan gets about 2.5. That gap in cycles matters more than the extra $200 per month. Because each double becomes the base for the next, losing a double isn't linear, it's exponential. Here's where most people mess up. They look at the contribution total and stop. Jordan invests more per month and thinks, I'll catch up later. But returns earn returns. The largest jumps show up in the final decade, when your balance is biggest. If you skip the early years, you skip the setup that makes those late years powerful. Think of a quick Rule of 72 lens. Start at $10,000. One double gets you to $20,000, another to $40,000, then $80,000, then $160,000. Notice how the fourth double added $80,000 by itself, more than the first three combined. That's why the last decade does outsized work. And that's why Alex's extra doubles outweigh Jordan's higher monthly input.
Now, the practical question. What do you do with this? If you're in your 20s or early 30s, you don't need perfection. You need participation. Automate a monthly transfer today, even if it feels small. That small buys you an extra doubling window you can't add later. Use low-cost index funds to keep frictions down, reinvest dividends, and let the machine run. If you're already later in the game, don't panic. Your edge comes from intensity and consistency. Boost the rate, increase the frequency, and tighten costs. Make sure more of every dollar compounds for you, rather than leaking to fees or taxes. Dollar cost averaging is your friend here. Scheduling fixed buys takes the drama out of market swings and aligns your behavior with long-term compounding. You buy more shares when prices are low, fewer when they're high, and you stay invested long enough to collect those crucial doubling cycles. This is the boring, repeatable habit that actually moves the needle. One quick micro story. A client delayed for years, waiting for the right moment. They finally set an automatic $250 monthly contribution. 12 months later, the balance wasn't life-changing, but the habit was. They'd locked in another doubling window. The moment they saw their statement grow through both up and down months, the hesitation vanished. Action beats perfection. Bottom line, time multiplies money more reliably than money multiplies money. Start now, keep costs low, automate the behavior, and protect your doubles. The earlier you plant, the taller the tree. Let's shift gears and talk engines. If time is your multiplier, the return you choose is your throttle. The Rule of 72 makes the speed differences obvious, and honestly, once you see them side by side, it's hard to unsee. Start with cash and basic savings. At 1%, 72 divided by 1 is 72 years per double. That's nominal, and we've already said inflation can quietly erase that win. Cash is for safety and bills, not growth. Use it as a safety sleeve, not your wealth engine. Short-term treasuries have looked more attractive recently, around 5%. 72 divided by 5 is about 14.4 years to double. Better than cash, still slow relative to equities. Treasuries can be a stabilizer, a place for near-term needs and ballast against volatility, but they aren't designed to outrun inflation over decades on their own. Now the workhorse, a broad stock index. Historically, a diversified U.S. large-cap index has returned around 10% over long periods, though year-to-year swings are messy. 72 divided by 10 is 7.2 years per double. Over a 30 to 40-year career, that's multiple doubles, and those later doubles do the heavy lifting. This is why low-cost index funds are the default for most people. Diversification, low fees, and a timeline that makes 72 work for you. Real estate often sits in a similar long-run zone. Call it roughly 8% historically in the U.S., depending on region and whether you count rents and leverage. 72 divided by 8 is about 9 years per double. The twist with real estate is the combo of rental income and financing. Leverage can amplify returns if you buy well and hold through cycles, but it can also amplify pain if rents soften or rates jump. The rule helps you compare pace. Your underwriting and patience manage risk. On the high volatility end, you've got assets like Bitcoin, which have posted eye-popping historical periods. Think average annual returns that imply sub-1-year doubles. The problem isn't the math, it's staying in the seat. Drawdowns can be brutal. A short doubling time only helps if you participate through full cycles. That's why some investors keep these as tiny slices, 1 to 2%, so a crash doesn't knock them off plan. Here's the catch most people ignore: real versus nominal. If inflation runs at 4% and your nominal return is 6%, your real return is about 2%. 72 divided by 2 is 36 years per real double. That's a different life outcome than you thought. Use a 2-pass 72. First nominal, then subtract inflation, fees, and taxes to estimate real. That's the number your future self spends. Risk balance matters. Diversification isn't about owning everything. It's about pairing different drivers so not all your money reacts to the same shock. Stock indexes for growth, treasuries or cash for stability and liquidity, real estate for income and inflation sensitivity, and, if you must, a tiny asymmetric slice for optionality. The goal isn't the shortest theoretical doubling time. It's the highest probability of logging multiple doubles without blowing up. So, use 72 to rank your engines, then use your risk tolerance and timeline to choose a mix that can actually finish the race. You want enough growth to outpace inflation, and enough resilience to stay invested. Now that you can estimate nominal doubles across assets, we need the step most people skip: converting those nominal doubles into real purchasing power doubles. Because that's the only speed that matters in retirement. Before we go any further, this is the part that saves people years. Nominal doubles look exciting on a statement, but your future self spends purchasing power, not raw dollars. If you don't convert your nominal return to a real return, you'll misjudge your timeline, retire later than planned, or withdraw more than your portfolio can support. Here's why this matters. Inflation stretches the road in front of you. Fees and taxes add headwinds. If you plan using only nominal returns, you'll think you're traveling 70 miles per hour, when, honestly, your effective speed is 40. The result is overconfidence early and disappointment later. We're not doing that. So, the method. A conservative planning shortcut is real return, approximately nominal return minus inflation, minus fees, minus taxes. It's not perfect, but it's practical and it keeps you honest. If your nominal assumption is 8%, inflation is 3%, and combined fees plus taxes cost 1%, your real return is about 4%. Now apply the rule of 72 to that real number. 72 divided by 4 equals 18 years per real purchasing power double. That single conversion turns a feel-good plan into a real plan.